Welcome to The Explainer. Today we are going to tackle two of the most critical and honestly most confused terms in all of investing: volatility and risk. Understanding the difference isn't just some nerdy thing for Wall Street. It is the key to building your wealth with confidence and, maybe more importantly, actually being able to sleep at night.
So let's just jump right in with a question that really gets to the heart of what makes so many of us investors nervous. When you see the market start swinging up and down like crazy, does that automatically mean you're in real danger? Well, the answer, as we're about to find out, is a surprisingly powerful no.
To really get our heads around this, let's use a simple but really powerful analogy. I want you to forget about the stock charts and all the financial jargon for just a minute, and instead just imagine your entire investment journey as one long road trip.
Okay, so you're on this cross-country drive. Volatility, well, that's just hitting a rough patch of road. A bunch of potholes, maybe some gravel. It's jarring, it's definitely uncomfortable. You might even spill your coffee, but the key thing is you're still moving forward, you're still making progress toward your destination. Risk, on the other hand, is something totally different. Risk is that terrifying sign that says, bridge out ahead. It's a washed-out road, a sheer cliff face. It is the very real chance of a permanent journey-ending catastrophe, one that you just can't recover from.
All right, so let's get a little more specific and put a real definition on those potholes. What exactly is this bumpiness that we call volatility?
So the textbook definition is that it's a measure of how scattered an investment's returns are. But let's put that in simple terms. Volatility is completely direction blind. A stock that rockets from $20 to $100 is considered volatile. But guess what? A stock that plummets from $100 down to $20 is also volatile. The only thing that matters is the size and speed of that price swing, not whether it's making you cheer or panic. It's purely about the magnitude of the change.
And you'll notice volatility isn't good or bad. It's just a characteristic. Think of it this way. Some tech stocks are like a winding mountain road with super sharp turns. Exciting maybe, but a lot of movement. Now think of a stable utility company. That's more like a smooth, straight highway. Neither of those roads is inherently better than the other. It just depends on your car, your destination, and frankly, how much turbulence you're willing to handle.
And this isn't just a feeling. We can actually put numbers on it. Standard deviation is the classic way. It tells you how widely an investment's returns have bounced around its average. But for someone like you or me, I think beta is often way more useful. So the entire market, let's say the S&P 500, is given a beta of exactly 1.0. A stock with a beta of 1.5 is 50% more volatile, a bumpy ride, than the market. A stock with a beta of 0.7 is 30% less volatile. And then you've got the VIX, which people call the fear index. It basically tells us what the market thinks the volatility is going to be in the near future. When the VIX is high, it means investors are buckling up for a bumpy ride ahead.
So if volatility is just the bumpiness of the road, what about the real dangers? Let's turn our attention away from the potholes and start talking about the cliffs. Let's talk about true investment risk.
Okay, this is the crucial point. Risk is not the temporary discomfort of seeing your portfolio value go down for a little while. Risk is the very real probability of a permanent loss. The company you invested in goes bankrupt and the stock literally goes to zero. Or, and this is just as important, it's the risk that your investments grow so slowly that you completely fail to reach your financial destination, like a comfortable retirement.
Now, all investment risks really fall into two big buckets. First, you've got systematic risk. Think of this like a massive snowstorm that shuts down all the highways. It affects everybody. There's no way to avoid it. A recession, a global pandemic, that's systematic risk. Then you've got unsystematic risk. This is like getting a flat tire. It's specific to your car, just one single company. Maybe they had a terrible product launch or their main factory burned down. It's a huge problem if that's the only car you own, but it's not such a big deal if you've got a whole garage full of them.
And this is where you, as an investor, have real power. That flat tire, that unsystematic risk, that's what happens when you put all your money in just one stock. The market doesn't reward you for taking that kind of specific risk. But the amazing thing is, you can get rid of it almost entirely and for free, just by diversifying your investments. It really is the only free lunch in investing.
Okay, this brings us to the absolute core idea of this whole explainer. Now that we understand the difference between a bumpy road and a cliff, let's look at how they can combine in some really surprising and, frankly, counterintuitive ways.
This matrix right here, this is probably the single most important takeaway. So let's walk through it nice and slow. Top left corner, high volatility but low risk. What's that? It's a diversified index fund that you hold for 30 years. Sure, it's going to be a bumpy ride, but the chance of you permanently losing your money is basically zero. Now, top right, high volatility, high risk. This is your classic meme stock. The price swings like crazy, and the chance of the company going to zero is very, very real. Bottom left, low volatility, low risk. Simple. Think US Treasury bills. The price barely moves, and they're about as safe as it gets. But the most dangerous quadrant of all is the bottom right, low volatility but high risk. This is the company in a dying industry that looks totally stable right up until the day it goes bankrupt. It's a perfectly smooth road that leads you directly off a cliff.
So, how do you know which one of those boxes you're in? What's the thing that separates the bumpy but safe path from the bumpy and dangerous one? Well, it almost always boils down to one single critical factor.
Your time horizon changes everything. Let's say you're saving for a house down payment you need in 2 years. For you, a 30% drop in the market is a catastrophe. In that case, volatility is risk because you simply don't have the time to wait for a recovery. But now picture a 25-year-old saving for retirement in 40 years. For them, that exact same 30% drop isn't a risk at all. It's a Black Friday sale. It's an opportunity to buy the world's greatest companies at a huge discount. For that person, the real risk isn't the market bumps. It's inflation silently eating away at their savings if they're too scared to invest.
So this is all great in theory, but how do we actually apply it? How do you use this understanding to build a better portfolio for yourself and successfully navigate your own financial journey?
It really comes down to 3 fundamental steps. First, know your destination. You have to define your timeline for every single dollar you invest. Second, build a durable vehicle. That means diversifying widely, not just across different stocks, but across different kinds of assets like bonds and across different countries. This is your ultimate defense against that specific flat tire risk. And third, and this might be the hardest part, you have to stay the course. The biggest risk for so many investors isn't the market, it's themselves. It's that behavioral risk of panic selling right at the bottom and locking in your losses for good. Don't swerve when the road gets bumpy.
And for that long-term investor, the one who sees those bumpy roads as an opportunity, there's one technique that is practically tailor-made to turn those bumps into a huge advantage.
It's called dollar cost averaging, and it's actually what most of us do in our retirement accounts without even realizing it. By investing a fixed amount, say $500 every single month, no matter what, you completely automate your decision-making. When the market is down and prices are low, your $500 automatically buys you more shares. When the market is high and prices are expensive, that same $500 buys you fewer shares. Over time, this discipline forces you to buy low, smoothing out the bumps and turning volatility into your greatest ally.
You know, when it's all said and done, it comes down to this simple idea. Higher returns don't just happen for free. Volatility is simply the price of admission. It's the fee you have to pay for the incredible opportunity to build long-term wealth on the stock market.
So the ultimate takeaway here is to completely recalibrate your mindset. Stop obsessing over the day-to-day or even month-to-month turbulence of the market. That's just the road condition. Instead, focus all your energy on identifying and avoiding the true risks, the permanent cliffs of putting all your eggs in one basket, of investing in a failing business, and of having a plan that doesn't match your time horizon.
And so that's the final question I really want to leave you with. On your own investment journey, when you look at your portfolio, what is it that you see? Are you completely fixated on the potholes right there in front of your car? Or are you keeping your eyes firmly on the horizon, focused on your ultimate destination? Getting that right, that is the true key to success.